What's up, everyone? How are we doing? I'm Mark. I work alongside with Tristan, and I have here Bethany and Mike with AssumeList, and they got some really powerful stuff for you guys today. I had a little bit of a chance to do a little sneak peek on their company, and I know a little bit about them, but they're going to tell it to you guys best of what they do. They got some really cool stuff that's happening right now. It's going to give you a lot of ammunition for your business and for your clients, and maybe even for your own portfolios. But without further ado, Bethany and Mike, please take it away.
Yeah, why don't we just wait a minute or two here because I see people are still coming in, Mark. So I
Sure.
know it takes about a minute or two for folks to actually join into the Zoom call here. So we'll just give them a few seconds to load in, and then
Yeah,
we'll absolutely kick this thing off.
for
We're
sure.
Mike,
Absolutely.
Mike, do you want to start off with an overview of the assumption process?
Yeah, we want to go ahead and I guess we can start right now. So let's just talk about what we plan to cover today, right? So today's topic is we really want to talk about how to bulletproof assumable purchases or assumable transactions, right? So everybody has a buyer or seller who is interested in this, either because they're selling a home and they want to maybe make their next purchase assumable mortgage, and they don't want to give up maybe they have a really low interest rate right now and they don't want to give it up to purchase a home at a higher rate. So sellers are interested in this, and of course, anybody who's looking to buy a home is also interested in assumable mortgages. There's nothing like finding your next home with a 2.5% interest rate. Yes, rates have gone down over the last 2 weeks or so, but still, from 7% to 6%, still a far cry from a 2.5 or 2.75, where a lot of our buyers right now are purchasing their homes with those rates. So today's discussion is really just talking about the how to really strategize and build a comprehensive game plan around working with an assumable transaction and really bulletproofing those steps along the way to really maximize your chances of success. There's a lot of agents out there that have tried it in the past. Maybe that I've heard a lot of people about, oh, somebody in my office tried to do this, or I have a colleague or a friend who did an assumption several months ago and it was a horrible experience. Maybe in some cases the deal fell apart, they didn't even get through closing. And so we really want to talk about what those pitfalls are and how we can help address them and set everybody up for success. So when you go forward into your next transaction, you know what to look for, you know what those key points are, where to really maximize your time or spend your time to address those shortfalls to improve your chance of success. So the first thing we want to talk about is I'm going to provide a quick, broad overview of the general steps for an assumption, right? Generally speaking. And what I mean by generally is variations do occur on the peripheries from servicer to servicer. So generally the process will look like this, but just keep in mind as I go through this, the specific timeframes and how each servicer does it may vary based on their own internal policies and how they process assumptions. But how it normally starts, of course, is a buyer would submit an offer to a seller with the standard terms, standard offering agreement, standard contract, and you would ratify that contract. Now we're going to talk about specific documents that may be applicable that we would recommend a little bit later on in this seminar, in this webinar rather. But just the general broad brush overview: ratify sales contract, kind of step one, right? So obviously that's clear. Step two, once the contract is ratified, this is where things always start going south. It's like, well, who takes the first step? What is the process to actually begin the assumption? So generally speaking, the way it starts is the seller will always contact their servicer to initiate the assumption process. And that generally involves them making a phone call, calling in their servicer, whoever they make their mortgage payments to, and requesting an assumption package. Most of the time, that assumption package will be emailed to the seller. They'll probably transfer them to an assumption team. They'll inform them that they have their home under contract through an assumption contract. So the buyers are assuming the loan and they want to initiate the assumption process. That servicer will issue them usually some preliminary documents. Most of it will include just basic information on the buyers. They're going to ask, well, who are the buyers, name, contact information, address, phone numbers, email address, mailing address, etc., along with what sometimes they call it a welcome package, sometimes they call it an orientation package, and it will include just basic terms of the contract itself, basic terms of the sale, the transaction, the loan itself, the loan number, just so that the servicer has something to start from. And that will usually be emailed back to the processor, emailed back to the servicer. And that's really kind of the second step. So first step, ratify the contract. Second step, the seller submits an inquiry to the servicer to request a assumption package or an orientation package, whatever that's called, and that will be sent back to the servicer. There should be some of those forms may be filled out by the buyers. Some of those forms that are sent may be filled out by the sellers. Step 3 is the lender, now that they have the buyer's contact information, will reach directly back out to those buyers to initiate the assumption process with the buyers. And that timeline could vary drastically. It could be within 24 to 48 hours after receiving that seller package. It could be 2 or 3 weeks, just depending upon the servicer and how quickly they can assign a loan officer to initiate that conversation and really initiate that process with the buyer. It's at that time, that point, when the buyers are invited to submit their financials. They're submitting all of their documents, their tax records. All of those things can't happen until they initiate that call, until the servicer initiates that call with the buyers. And usually it's after a loan officer or a processor has been assigned. And those terms are used different, different depending on the lender involved. So now we move on to the next step. Buyers submit their financials, and then what happens after that? Well, then it goes in through the standard review process, right? So now we're doing a typical underwriting review. The difference between a standard or new loan and with this assumption process is those reviews are often multiple tiers. So it's an initial review. Most likely there'll be some additional documents that are requested, and then there'll be a second review after those documents have been reviewed. Once they have everything and they basically agree, yes, we've received everything, then finally it will be sent into the underwriters for final underwriting approval. Once that occurs, it will be sent over to the closing department, and at that point, it will be assigned a closing date or settlement date. And so, again, different teams, different people throughout the process, and then finally, once it goes through closing, that's when the closing disclosure and any final documents are organized or are coordinated with the settlement company or title company, and then it goes to closing from there. So there's a lot of steps kind of that will be we just talked about, and there's a lot of pitfalls along the way. We're going to talk through some of those in detail, but I just wanted to kind of baseline, just open up the webinar with just a baseline, how that process works, and who's responsible for what along the way. And we'll go through some of those more in greater detail as we go on.
Fantastic. Well, we actually have our first question here by Kimberly. She wanted to know, is there an appraisal?
No, there is not an appraisal with assumption. So the way the assumption process works is effectively the buyers are assuming the existing loan with the existing terms. So from the lender standpoint, there's no new loan and there's no reason for an appraisal because the loan terms have already been agreed to and defined and are set. So with the terms have already been set, all the lender is doing is reassigning the existing loan from the seller's name to the buyer's name. And of course, they're going through that financial review process just to make sure that the buyer is financially qualified. But there is no new appraisal because there's no reason for it. There's no new loan being issued. There's no valuation being determined as part of this transition because the loan itself is already in place and all those terms have already been defined and will remain in place through the assumption closing.
Got it. Perfect. Let's see here. We have another question. Do the sellers have to be current, for example, don't qualify for a short sale, but are behind?
Yes, great question. So yes, this is specifically for VA. I believe this applies to FHA assumptions as well, but I know specifically for VA loans, absolutely the seller must be current on their mortgage in order for the assumption to go through. However, that can be done at the time of settlement. So for example, if a seller is behind 1 or 2 or 3 months, of course, as long as it hasn't gone through foreclosure, as long as it's any time up through pre-foreclosure proceedings, even if the seller is behind on their payments, as long as those payments are made at the time of settlement and at the time that the title transfers, the mortgage becomes current, then the assumption can go through and all that can happen at settlement. So it's not as if the seller needs to miraculously come up with some money prior to closing so that they can go to closing. The proceeds from the settlement can be used to make the loan current. Good question.
Got it. Yeah. And then also question, would a buyer be able to get a second loan for the difference in price?
So that's a whole separate conversation. We talked about second mortgages in our last webinar. I would encourage you guys to look at that video. We did a 30-minute presentation. We brought in a lender. We talked through all the terms and nuances of how second mortgages work, when they're applicable, how they work. So I would encourage you to watch that video because it went to a lot of great detail. The short answer is, though, in some cases, a second mortgage is possible. There's a lot of variables that go into play. Does the servicer allow second mortgages? But it is generally possible. It does add a layer of complexity for assumptions because now there's another loan involved in the transaction. Again, to learn more about those details, I would encourage you to watch our previous video, which we cover this in great detail.
Good deal. Cool. Let's see here.
So,
No open questions as of right now. Did you want to, you're about to say something?
Yeah, let's move on to the next topic. So Bethany's going to talk us through kind of knowing your numbers and talk through kind of what are some of the other pitfalls and how to work through them. So Bethany, take it away, please.
Sure. So one of the first recommendations we give, and this is really going to be helpful to both buyer's agents and listing agents in the process, is understanding the buyer's financial picture. And obviously this is true even when you're doing a standard purchase, but in our opinions, that much more important when you're doing an assumption, because the nuance about assumptions, of course, is that, when you do a regular purchase, typically whatever pre-approval the buyer submits with the offer, they probably have some intention to work with that lender. They might change and go to a different lender, but oftentimes if we're introducing them to a local lender that we've worked with many times, who we know has a high track record of success, who we know vets that buyer's documents heavily, that they submit taxes and pay stubs and do credit checks. And there's a level of due diligence there with a standard purchase that the local lender provides that helps both the buyer's agent and the listing agent feel comfortable that this buyer is qualified and that they're going to be able to get the loan and the purchase is going to go through. The nuance of assumptions is that rather than the buyer being able to pick their own lender, they are going to end up working with the servicer, that lender, whoever owns the loan today, in order to get the loan. That said, whoever the servicer is, we don't necessarily have a good picture of what their pre-qualification process is like. And you're not necessarily going to be able to hand the listing agent for the assumption sale a pre-approval from a large institution and say, our buyer's good to go. They've been fully vetted and here's the name of our loan officer and their direct cell phone number. You just don't have that same level of communication with a big bank that you do with a local lender. So one of the recommendations that we have to help bulletproof the assumption is to still have your buyer go through a pre-qualification with a local lender, someone that you've worked with many times, who has a lot of diligence at the front end, that you can then submit with that offer to help the seller and the listing agent feel good about that buyer's financial profile. In addition to that, the other nuance with assumption transactions is the down payment is really dictated by the current loan amount. So rather than the buyer picking how much they want to put down, you've got whatever the loan balance is subtracted from the purchase price, and that becomes your down payment. So if the purchase price is $1 million and the loan amount is $700,000, the down payment is $300,000, no more, no less. And so another element that really helps that seller and listing agent feel comfortable is if the buyer's plan is to pay that amount in cash, to have them show some sort of a bank statement or cash statement from their institution showing that they have that money available to cover the down payment plus closing costs at closing. That way there's no questions about, where's the money from the down payment going to come from? Do they need a loan for that difference between the down payment? No, we've got a financial statement that says this is what they've got in their bank. It's clearly enough to cover what the down payment is. Everyone's good to go. And this just helps, obviously, as a buyer's agent, this helps you get that deal accepted on the seller side because now they feel comfortable with your buyer's numbers. If they've never done an assumption before, you're probably already doing some level of helping them feel comfortable with the process by explaining how it works and explaining your plan for getting it to go through. This is just basically going to take some of that discomfort off the table by showing that your buyer is super well qualified to purchase. Really what you need to do is show them they're well qualified to purchase within that same monthly payment. But a lot of the modern buyers we're finding, they would qualify to buy a home even at the prevailing interest rates. They just would prefer to do an assumption so they can get a lower monthly payment. So really with that new pre-approval, if they're good to go to purchase even at 6%, 7%, they're definitely going to be good to get qualified at that much lower interest rate. So it just helps them feel comfortable in that regard. The next layer that we wanted to address is sort of setting expectations. And so, I alluded to the fact that when you put in the offer, you're probably doing some level of this already with the listing agent by explaining to them, like, listen, an assumption is a little bit different than a normal purchase, and here's how. Specifically, when you're setting expectations with the other side and with your own clients, you want to be honest about the timeframes that might be required. So typical purchase, we can see anything from as short as 2 weeks to, maybe 30, 40 days is pretty average where we are to get a regular loan and go through title and all that stuff. For an assumption purchase, it varies by servicer, but you're generally looking at something anywhere between 45 and 90 days, kind of depending on who the servicer is and how quickly they provide the assumption package to the buyers, how quickly the buyers submitted, how many questions the servicer has. So you have to know that, number one, to manage your own clients' expectations. If there might be a day or two delay because the servicer tends to do that, you want to let them know, like, listen, don't schedule your movers for the afternoon of settlement. That's not going to go well for you. Let's make sure, let's get closer to settlement. Let's feel more confident about that being our date. And then let's schedule the movers. Same thing on the listing side. If that seller is trying to go buy their next place and they need the cash from this sale to do it, set expectations with them and say, like, listen, I know you want to close right on September 15th. I've worked with the servicer before. It might be a day or two later. Let's not count on him going to put out an offer on the weekend of the 17th. Let's imagine it could be the following weekend before they're able to do that. You never want to set rosier than average expectations and then look like a goofball when the servicer can't meet them and you've overpromised and underdelivered. So having everybody understand the process up front, the time that it can take, depending on the servicer, there can be variability in the quality of the communication as well. We've had some servicers that are good communicators. They'll reach out to you as soon as the home is under contract. They will communicate with you every couple of days to let you know where things are. They'll ask questions. They'll confirm receipt. Other servicers, it's like working with a government bureaucrat. You might not hear back from them right away. You might have to ping them a few times. You want both your buyers and sellers to be cognizant that that can be the case so that no one feels overly frustrated by what they thought was going to be a regular process. And it's actually a lot less. There's less touch points than they might be used to for a regular purchase or a regular sale. And so having everyone clear up front can just help it go a little bit more smoother, help there be less people banging their heads against the wall because it's not going how they thought it would if you're just completely clear about it up front.
Wonderful.
Yep.
Awesome. We have a question here. If we're open to that now, or unless you guys had more to say right now.
Yeah, go ahead. We'll keep going after that.
Awesome. So we have a question here. I was pretty shocked at the fees associated with an assumption. Do you have a sample of fees? What is normal? It seemed doable. That would be on a new mortgage. Is that normal? Or sorry, double. Would that be? Is that normal? This was a VA assumption.
Yeah, so I'm going to post in the Q&A a link to answer this. I'm not sure if this goes out to the general public, but you can also access it on our website, assumelist.com/blog. And then there's one called FHA and VA fee update. And it talks about the fees, recent changes to the fees that banks, lenders can charge for assumptions, both from an FHA assumption and a VA assumption. Since the question was specifically asked about a VA, the short answer is that the servicer up until about a month ago was limited or capped at $300, and that has since been modified. The VA came out with a circular, I believe, in the May timeframe. So I guess a couple months back now, that added a locality variance to the amount that the servicer can charge for a VA assumption. And that ranges anywhere from $386 to as much as $463 in that link that I sent out. And if you go to the assumption fee update article, it will explain there's based on the region, east, south, northeast, Midwest. Bottom line though is, generally speaking, servicers are capped at the 300 plus that locality variance. So let's just say, generally speaking, about $700 or so that they can charge as a maximum amount of fees that are able or allowed to be charged for a VA assumption. Now, this is separate from the VA assumption fee, which is paid directly to the VA. So it's not to the lender, and that is 0.5%, so 0.5% of the remaining loan balance that's determined, at the time that the assumption is processed. So whatever that loan balance is, 0.5% or 0.5% of the loan balance is charged to the buyer at closing as part of the VA assumption fee paid directly to the VA. Though, of course, that is can be waived if the buyer is a disabled veteran. And that is in lieu of a typical VA funding fee for VA. So the assumption fee paid to the VA, the processor fee or the processing fee to the lender capped at roughly $700. And really that's it. Those are the only fees that the lender is able to charge for this. And this is separate from, of course, taxes and title charges and surveys and any other thing that would typically be applicable to a purchase, of course, is still paid as part of closing costs. But in terms of lender fees, it's limited to just those two.
Awesome.
All right, let me go on. Let's talk real quick about effective communication. So Bethany spent a good amount of time about setting expectations. And really the key point of there, the key takeaway is that, a lot of deals end up going south because one party or the other, whether it's the buyers or the sellers, have varying expectations from what they thought would happen versus how assumptions actually are executed and, and are done in practice. And really the responsibility to ensure that the transaction goes smoothly is really based on setting those expectations up front. And so the respective agents, whether it's the listing agent or the buyer's agent, really needs to understand this process. And we spend, of course, a lot of time educating agents around the country. And a lot of these horror stories that you may have heard or that others have experienced really has to do with just not really understanding the process or not understanding what is to come next or how long that process will take. And of course, their respective clients get frustrated. And everybody, the agents look like the bad guy, the bank looks like the bad guy, right? Everybody just gets frustrated in the process. So one thing that I always do with all of my assumptions is that I like to establish, and this is just based on my own, best practices, right? Is the importance of establishing who is really going to take the lead with communicating with the servicer. So the reason why I say that is because servicers don't generally, as Bethany pointed out, some servicers are more effective with communication and some are less so. So bottom line though is anytime you can communicate with the servicer to understand where we are in the process is good, right? You want to have that open dialogue. I rarely find that they answer their phones. It's not like, your favorite lender who, when you call, that lender will pick up. That's not necessarily the case with these institutions that are processing assumptions. They generally don't answer their phone. It doesn't mean that all of them don't, but from my experience, the most effective way I'm able to communicate is via email. What I like to do is establish with at least my transactions is who's going to be the primary point of contact with communicating with the servicer. Obviously, in my cases, I generally recommend that it's me, just because obviously I have a large experience base and a lot of knowledge on how these processes work. But establish who will be the primary point of contact, whether it's the listing agent or the buyer's agent, somebody who has probably the most knowledge, most experience with this, has a better understanding of what to expect and how the process works. The reason why I say that is because what you don't want to do is have both agents pinging the processor every day with the same questions. Hey, where are we? What's next? What's going on? Are we clear and right? Has the buyers, we don't want this listing agent to ask the processor whether or not the buyers have submitted certain forms, or whether, are we waiting on anything from the buyers? Like, that conversation should happen between the two agents directly. And so the more that you're pinging the processor with these questions, right? And especially if they're repeated over, and the buyer's agent and the listing agent are asking the same questions back and forth to the processor, it slows down the process. So what I always recommend is establish who is going to be the primary point of contact, communicating with the servicer, and that really requires the listing agent, the buyer's agent, to really work together to communicate effectively, so that whatever questions are deemed to be needed to be asked maybe they can be asked without even asking the processor, right? So obviously, what forms have been submitted? Is there anything pending? A lot of these questions can be answered just back and forth between the two agents, and let the processor run that underwriting, or getting that through the system. The other thing I like to do is, whenever I communicate with the servicer, I often CC the listing agent on there, just to make sure that they know I've asked a question, and that when the response comes back, I usually request that the servicer reply all, so that everybody can see the updates. And that really goes a long way to keep everybody informed. Now, it will require on the front end, with submitting third-party authorization forms, so that the servicer is allowed to communicate again with you as whatever side you are on, and also your counterpart, whether that be the buyer's agent or the listing agent. Third-party authorization forms are required, and that's always part of that initial package that we discussed early on in this webinar. Is there's that welcome package, orientation package. One of the forms that the seller will need to sign is that third-party authorization form for both agents. And I always recommend that they sign that for both agents, so that either agent has the ability to communicate. But more importantly, when a question is asked, the servicer is allowed to respond to all parties and inform both agents in the response. They won't do that unless they are allowed to communicate about the loan, which of course would require the third-party authorization form to be submitted and filed early on in the process. So again, these are just small little tips: streamlining communication, establishing a primary point of contact, and then also communicating directly between the two agents before you go back and ping the servicer for updates, because a lot of those questions I find can be answered through communication directly with each other. Sometimes, depending on the servicer, they will respond directly with the clients, whether it's the seller or the buyer, and not include that correspondence with the agents themselves. And so what I find, a lot of my transactions, I'm as the representative for buyers in most of my cases. I'll contact my buyers. Hey, have you heard from the servicer? I haven't heard anything in the last week. Before I email them, I just wanted to touch base with you. Have you received any updates, or have you received any emails recently? And sometimes the answer is yes. We just got an email yesterday, and they asked us for X or for Y. And I didn't know about that. So if I were to have emailed directly back to the servicer, I would have been behind the power curve, because that correspondence, that conversation already took place with the clients. And so just understand the workflow of how assumptions happen is different than a traditional purchase, because servicers are, they literally follow the path of least resistance. If they need something answered, they will go to whoever the person they think will be able to answer it. And sometimes, in many cases, it's directly to the clients and not to the agent. And so sometimes it may feel as though the agents are left out. And so I always recommend that really good coordination with your client and with your counterpart agent in the transaction before you ping the servicer over and over again, because eventually what they may do is just shut you down. And that's not a good place to be in. And that will further slow the process, because if you do have an urgent issue that you need addressed, the servicer has already been tuned off from communicating with you because you've been nothing but a headache for them, right? So you don't want to create that environment. It is a different relationship with an assumption with agents and servicers than it is with you as an agent representing a client through your traditional purchase with a lender that you maybe have a great relationship with. That process is a little bit different and the workflow is different. So we'd like to spend a few minutes on that to really help people understand how to best communicate to ensure, and basically create efficiencies throughout the assumption process.
Awesome.
All right. Is there any questions, Mark? I think I saw one or two. Is there anything else in there that we should jump on before we move on? What do you see in there? Anything?
We are good on questions here. We answered them all at this point.
Awesome. All right, we'll wrap up. There's a couple things that I just wanted to close out with, and certainly Bethany may want to jump in on this as well, is how do you handle delays, right? This is the biggest question that we get, right? What are the strategies for managing transaction delays? Well, first and foremost, you need to understand what a delay is and when it actually occurs. And so a delay really comes down to, and this is relative to the specific servicer that your deal is happening with. So I'm going to use names, and I don't mean to be disparaging to one servicer or another, but this is just based on my experience from assumptions that I personally have under contract right now with clients. So I have 4 or 5, I think 5 contracts, 5 assumptions under contract right now. I'm going to just use 2 servicers as an example. Freedom Mortgage, which is one of the better servicers in the country for VA assumptions. And there's another one that I'm working with Mr. Cooper, that I'll say just less than stellar experience. The difference between the two and how do I define when a delay is I know inherently that when I'm working with Freedom Mortgage is that the expected timeline for that closing from the time that we submit the contract to initiate that assumption till we go to closing is roughly 60 days. And so if we're at day 45 and you're thinking to yourself, man, why is this taking so long? Well, just know that their closing timeline is about 60 days. They will tell you at the beginning, plan on up to 90, but just know that Freedom Mortgage can process in 60 days. And unless you have some basis to make that reference, you don't really know when a delay actually occurs. That compared to Mr. Cooper, generally speaking, is about a 75-day closing timeline. So if, for example, we're at day 65 or 70 and I haven't closed with Freedom Mortgage, I'm thinking to myself, okay, there's obviously a delay here because I just closed my 3 other preceding VA assumption transactions with Freedom Mortgage in 58 days, 59 days, and 60 days, and now I've got one at 70. Obviously, something is taking a little bit longer versus Mr. Cooper, where I have one right now that we're just about the 74, 75-day mark, and we're looking to close next week. That is in line with expectations for Mr. Cooper. So that is not a delayed closing from their processing standpoint. And you need to understand what is a delay relative to the servicer that you're working with. Some servicers can close as quickly as 45 days. Some will take, like Mr. Cooper, about 75 days. I don't think there's any remaining out there that will take a full 90. However, that is all predicated on how quickly buyers are submitting their documents when they're requested. So that when we first started the webinar, we talked about the various review periods when documents are requested from the servicer. The buyer submits those to the servicer, they go through initial review, then they have a subsequent review, and then a final review with underwriting. Every time there's documents requested, depending on how quickly the buyer submits those, if it takes a week for the buyers to go track down tax documents and forms and bank statements and then submits them a week or 10 days later, just remember that doesn't count against your closing timeline because there's nothing for the servicer to process if they're waiting for documents. So what I always tell my folks is, like, as soon as a document is requested, you want to submit that within 24 to 48 hours, and always have the timeline, the clock ticking on the servicer side, not ticking on the buyer side, waiting for documents to be submitted. Okay, so what happens when there actually is a delay? If you were expecting this to close in 60 days and you're now 75 days into a transaction, first understand what is the cause of the delay. Now, there is a VA circular that mandates that all assumptions must be approved within 45 days. But what does that mean? That means they must be approved within 45 days from when the submission of the package, the buyer submits their package to the servicer. So if it took you 3 weeks or a month before the buyer actually submitted all their documents for whatever reason, that 45-day window doesn't start until that package has been completed, meaning that everything that the servicer asked for was received. So even that is a little bit of a wishy-washy, and I'm a little frustrated. I called the VA on this because technically speaking, the servicer has an unlimited amount of time because they can piecemeal when they're requesting documents. So it's a little bit of a frustration that I have with the VA rule because that 45-day rule doesn't really, there's no way to hold their feet to the fire. But when there is a delay, right? So what is the case when there's a delay? If everything has been submitted and the servicer is just dragging their feet and making a decision, maybe they haven't submitted it to underwriting. Maybe it's been with underwriting for weeks and you're just waiting for an answer. There's a couple things you can do. Obviously, first step is contact the servicer. Sometimes I'll contact the processor. The processor's not answering the email, so I'll call their generic customer service line. I'll say, okay, the processor's name is Mary. Well, who's Mary's boss? And so I'll try to speak with his or her supervisor. Well, sometimes, and I'm working with this one of my transactions. Well, the supervisor's not being responsible. Who's his or her supervisor, right? And I'll start working my way up, and I think I'm in an example now where I'm talking with the vice president of the entire division to express my frustration as why they cannot communicate with me with a simple update on where we are in the process, right? So don't be ashamed or afraid or shy about working your way up through the chain of command to address specific concerns, especially if it's now impacting either the buyer or the seller in the transaction, where things have been submitted and you're just waiting for them to make a decision. The other thing you can do, aside from working your way up, right, is to reach out to the VA directly. And I found this to be effective in several cases, typically when servicers are dragging their feet or lack of communication. They are not responding. You cannot get a hold of somebody. You've called in several times. You've emailed several times. You've tried to escalate it. And you're just, day after day after day, there's no response. I typically will just call the regional VA office. I'll say, here's the loan number. I need your assistance. I cannot get the servicer to respond to this assumption request. They will engage if there's reason to do so. If you're only 3 weeks into an assumption, the VA is really not going to get involved. But if you're 3 months into the process and you're approaching 90 days, there's no reason at all under any circumstance right now that any assumption should take longer than 90 days. In fact, really 75 days is pretty much the limit, I would say, for an assumption before you're really you're going to closing. So if you're exceeding the 75-day mark from when you initially contacted the servicer and started the assumption process, that is really kind of cause for concern right now. Anything short of that, there's really not much the servicer or not much the VA will really engage in unless you've received some decline letter or something that really doesn't make sense. The servicer is not processing it. Maybe they told you there's going to be their lack of some internal turmoil within the bank itself where they're not actually able to process or some communication breakdown. Really, in those cases, of course, reach out to the regional VA office because they will assist. But just keep in mind, really, until you've extended beyond what that expectation was, and really across the board, 60 days is kind of the benchmark for assumptions right now. Some can do it shorter, some a little bit longer. 75 days is really the kind of on the longer end of assumptions, and really 90 days is the limit. I would never go into a deal telling anybody it's going to take more than 90 days, regardless of servicer. That is really unacceptable at this point. Really 75 days is kind of that standard, and really 60 days is standard, 75 days on the longer side, depending on the servicer. But point being, escalations, communication, use the VA as a last resort. They will help and engage if there's a need to do so. And really, working through the issue or understanding what the issue is is really the most important part of the process to really help get through the delay.
So Mike, let's get to one more question before we depart here. Sharon said her loan is conventional, and she says it's assumable. Chase is the bank, and they said that it would take up to 6 months. Is that normal?
No. Well, first off, generally speaking, conventional loans are not assumable. The only exception that I'm aware of is for next of kin transactions. So they do allow family members to assume. Some banks allow family members to assume conventional loans. All bets off when it's that type of scenario, because conventional loans are generally they're not government backed, right? They're owned through financial institutions, or it's a commercially invested loan. So the process for a conventional assumption, when they do occur, which is really, really limited in terms of scale, the volume of a conventional assumption, fraction of the total volume of assumptions overall. Typically, when we talk about assumptions, we're talking about government-backed loans, because servicers must conform to these government rules and regulations on how the assumption works. So VA and FHA, there's an addendum, a rider, when the buyer takes out that mortgage that guarantees those loans that are assumable. There is no such thing with conventional loans. The processes involved and the timelines involved are truly up to the servicer or the bank or the investor who owns that loan. They don't have to process them. There's no requirement to do so. And even the cases where they do, my understanding is they're really limited to family members who are assuming loans, from former family members, et cetera. So the rules around conventional assumptions really don't apply to this conversation, because they're specific to that banks and how their policy works. So I can't really comment on what an expected timeline would be for a conventional assumption. My general rule of thumb is I don't pursue them. I don't look for them. I advise my clients, if you see a conventional loan, just assume it's not assumable. We're going to focus on VA, FHA, USDA, and everything that we've talked about today would apply to those government-backed mortgages.
Perfect. Awesome. Well, thank you guys both so much. And the best way to get a hold of you is?
Yeah, so it's you can just go to AssumeList.com. So I guess we failed to mention this early on, but the best place to find properties with assumable mortgages, AssumeList.com. That's our website. You can search for properties. We're in 17 states, well over, I think, several dozen markets, major metropolitan areas around the country. And you can submit a ticket there through AssumeList if you wanted to reach out to us. Certainly somebody will get back to you within 24 hours. If you have any questions about the search platform, how to find assumable mortgages, feel free to let us know, and we appreciate it.
Perfect. Awesome, guys. Well, thank you so much. And thanks everyone for being here, and we'll see you next time.
Thank you, Mark.